It's an emergency? Notice. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Bank of America issues a dire warning to all customers saying they need to act now because we're going to show you why the sell-off in stocks that started 2 weeks ago is about to get much worse. Because this is our Sunday show, the show that makes you money, which is why every Sunday we like to look at the technicals, momentum, and machine positioning to help you make more money trading and investing. And with that, let's head over to Bank of America, where we picked today's story up with the flow show, as we're talking about now old school risk off. This is something we have not seen in a while. As Bank of America notes, people underestimate how much lower rates may need to go to stimulate a weak economy, no longer juiced by government spending. And that is a fantastic point, because we now know for certain the pandemic stimulus is gone from the economy. And at this point, 1 or 2 rate cuts isn't going to matter, which is why Bank of America is saying it's time to act, because they say sell the first cut, that is the first Fed rate cut, as hard landing risk now at 11% are clearly rising at a time of strong or soft landing consensus is sitting at 86%. And this is an issue because one very important difference in 2024 is the extreme degree to which risk assets have front-run Fed cuts, with stocks up 32% in the last 9 months versus an average of a 2% run-up to 12 occasions since 1970, indicating that we are perhaps on the cusp of a major correction in stocks. And Bank of America has the data, because they're saying if you look at the returns 3 and 6 months following the first Fed rate cut, well, throughout history, if we do experience a hard landing, which the data is now starting to suggest, it means things are only going to get much worse after that first cut. And as a matter of fact, when the Fed does cut, the bond market's going to front run it in a huge way, as Bank of America notes in past reports that they are very interested in suggesting clients go long duration here to hedge their portfolio and start rotating out of stocks in big ways. But even their clients are overly long stocks, as we look at the equity allocation now sitting at 62% for B of A private equity clients. And while they're long stocks, they're very short bonds, only holding around 20%. If you look at the historical allocation, it is much higher than that, somewhere right around 26%. And of course, during crises, it gets all the way up near 35%. And as far as cash to buy the dip, well, clients don't have a whole lot of that, as cash levels remain very low, as everyone has gone long the U.S. equity market at a time that Bank of America says, look, you're going to see a likely sell-off following the first cut, because this isn't a soft landing cut, it's a hard landing cut. The other problem we face now is August is the worst month for flows. We noted from Goldman in past shows that we see outflows of the equity market during August. That's a further risk here to seeing what could be a massive decline in equity prices that just only started 2 weeks ago. Let's take a look at what Goldman has to say as we now talk about machine positioning. They have modeled CTAs long 130 billion in global equities. That remains in the 84th percentile after selling 19 billion of equities last week. Look for that to accelerate. We're going to give you some charts on that. How about corporate share buybacks? Well, that open window is back and now runs till September 6th, so not very long. And as you see, 50% of corporates are now back in the open window, and it's done nothing to stop the sell-off, suggesting that we're only going to see more outflows and more panic. And the machines, as you're about to see, are going to be one of the biggest sellers, and they've been quiet for a while. As Goldman notes, over the next week in a down tape, we could see 51 billion of global equities, 13 billion out of the S&P 500. But over the next month, and this is the big risk now, because again, August is a terrible month for flows. If we see a significant down tape, which has already started, you're looking at 225 billion of global equities to sell, 64 billion just in the S&P alone. And that is a huge risk, because you can see from global CTA positioning, as we look at at how the machines are sitting, they're very long this market and could sell off in a significant way here. If we look at just U.S. equities alone, we note again, they're very long this market, which is why Bank of America is suggesting, hey, it's time to rethink your positioning here, because this first rate cut is going to be mid-September. We could see a big sell-off here due to the August historical flows. It's time to rotate out before this gets even worse. And if they look at their estimated global equity position as systematic macro, which takes into account CTAs, risk parity, and vol control strategies, and the vol control one we're going to take a bigger look at here in a moment, they're all along this market. And if we continue to see a sell-off, these machines are going to turn and burn to the downside in a huge way. Because here again, we look at, of course, the total systematic positioning of U.S. equities. It remains at one of the longest and deepest positions you've seen throughout history, and these strategies look to sell in big waves, which is why I want to take a look at the VIX itself here, because what we can know, because a lot of people are looking to say, is this the dip I buy? And the answer is no, it's not. Because if you look at the VIX, you see buyers come in somewhere around 31 to about 36 on the VIX, and right now we're sitting at 23, which means as this goes up and we see volatility rise, you're going to see buyers come in and try to short the VIX as all of these systematic machines are going to start selling. If you're looking for a dip, you want to wait, and we'll talk about this when we get there, when the VIX gets up here in the 35 to 36 range. Look for all the buyers then to come in and put an end to this rally. But for the meantime, let's talk about more machine positioning. Here we turn to Metre. They know over 55.60 on the S&P to buy, but we're now facing a big sell signal at 52.67. Friday's close was 53.46, suggesting the next wave of selling for the machines is soon to come with any further weakness, and once that starts, well, it's not going to stop. Now let's take a look at our screens and show you where I think the markets are going here. As we take a look at the S&P 500, we're looking at the largest ETF, SPY. Momentum clearly negative. Now the relative strength index is at 39. We have a negative cross on the moving average convergence divergence, or the MACD, and right now what we're seeing from traders is they're looking for oversold conditions. The problem is when you start to see an accelerated move to the downside, markets can not only say overbought for extended periods, but they can also say oversold. So what you're going to see is people try to come in and buy this dip and then face a big wave of machine selling. Here we see our Momentum Timer Pro. This takes a look at signals like the RSI, the MACD, and other technical signals and smooths them all out with a proprietary overlay. We note 8 consecutive daily sell signals. On the 1-month signal, we're seeing a move down in momentum, suggesting we're facing a bigger correction here. Now you'll note we have no position on the S&P. We got stopped out, and I told you, I know some people said, hey, wait a minute, you missed it because it went a little bit higher. And when you're facing a big sell-off, as I'm showing the charts, what you want is lots of dry powder to buy the dips. That's what you're looking for to make money. Upside target really unchanged. Downside target, we move that a little bit lower. And you know our machine position, which tends to lead the actual machines, are showing that based on our historical overlay, which is very unique, shows the machines on the fast algorithm like Metre should be short. So when they do hit their next target, look for them to sell aggressively to the downside. Long positions, we're looking for them to sell as well. And so that gives us all the positioning data we need to show the market here on a historical basis is likely to further sell off. Now let's take a look at the S&P here, because we've seen over the last 2 weeks a move down, and it's holding this blue line, which is a 100-day moving average, which has not really been a sign of support. The next big major point is right around 509 here, with possibly the 200-day moving average. But if we see a bigger sell-off, you're not going to just note that, hey, we're in a short-term oversold position. You're going to see a larger move down here to possibly right around 450. Let's zoom out and see where that looks on the 5-year chart, because you can see that puts us all right back to erasing this move all of this year, which the threat of going deeper into what looks like maybe right around 400 if there's enough selling flow to push this down. But let's take a look at the weekly chart here, because what I want you to see on the relative strength index and the MACD is we're sitting in overbought territory on a weekly basis. If this continues to sell off, you're going to get a much deeper correction here that's going to look more like what we saw middle of 2022, 2, particularly as August being the worst month for flows. Again, putting the case where we could see the S&P get somewhere down to the 400 range, and that would create potentially a buying opportunity. Because remember, even though we're seeing from Bank of America saying, look, don't buy the dip, on the way down, if we are indeed entering a bear market, there are some big counter rallies that happen here. And if you're a trader, that's exactly what you're looking for to make money. But if you are a subscriber to our reports, which you can get a 30-day free trial for, links in the description below will tell you when to be buying and what to do to sell to hold on to your money. Now let's take a look at the Invesco QQQ Trust as we look at tech stocks. Momentum here negative as well. Relative strength index at 35. MACD's got a negative cross. We're sitting right near oversold territory, but again, we're making the case of why this could be much deeper. Now, you know our machine positioning here on the fast algorithm is back short. This is a great signal because when this reverses, of course, we're going to alert our subscribers if they should take a trade. We're seeing the slow algorithm sell down as well, but look at this. On the monthly window for Momentum Timer Pro, we're seeing a sell signal at a mid-size range, suggesting that momentum's about to go max short on the monthly. Wherever this bottoms, we're going to have a tremendous opportunity to buy back into this. Let's take a look at, again, the charts now as we look at QQQ. And we see the same thing on the weeklies as we see momentum turning down, looking to create a much larger and deeper sell-off, potentially sending tech stocks. Could you imagine maybe all the way down to this 320 range, somewhere there between 340 and 320. Again, this has everything to do with the August flows and the machine positioning looking to sell as price goes down. Your next major line of support is at 438, and if that fails to hold, you have the 200-day moving average from a technical perspective, and then all bets are off after that, as there isn't a lot of volume till you get down here into the 370 range. Let's take a continued look at our equity picture. Small caps, which everyone jumped in as the Trump trade, that has now reversed in a huge way. It did briefly an intraday trading tag our upside target. We're leaving that sitting there, but we're revising our downside target a little bit lower. But notice machine positioning here is long, momentum is long, and where the big caps go, small caps will follow this trade, and that is setting up a big catalyst to the downside. Let's take a look at IWM here, and what do we see? It jumped up here, and next thing you know, sellers came in right below the supply zone, drove it back down. Buyers stepped in a little bit here in Friday's trading. Support right here at 202. A failure to hold that. You're down here in this 187 range all day long. And let's zoom out to the 2-year chart, potentially suggesting if it fails to hold this zone here, if there's enough selling, you're looking at a move all the way down here, potentially into the 165 to 170 range. That would be pretty much a strong indicator that we're headed into a recession. But again, remember, when we see these pullbacks in the early stages of a bear market, they're major buying opportunities, not something you own, but something that you rent. All right, let's take a look now at some other positions. Let's see where money is flowing into is the utility sector. We noted from Bank of America's report that money is flowing into utilities and REITs in a big way, but this is not the safety trade you're looking for. Here you can see the relative strength index is at 73. MACD positive cross. Momentum isn't just positive, it's massively overbought. You can see momentum on a 6-month, 3-month, 1-month basis. It's extended. We know machine positioning long here in a big way, and we're going to show you why XLU is likely to sell off. It's not the safe place people think, because when you look at the chart, you say, okay, this looks pretty good. Its price is rallying here as a broad equity market sells off. But when you go in and you overlay the VIX, or the volatility index, what you start to see is that people race into utilities as a safety trade, and then vol goes up, and then next thing you know, utilities get crushed. So that safety trade is only brief until everyone piles in, and then you see, of course, utilities will get annihilated, just like the rest of the stock market here. So be careful. This is not the safety trade that everyone's hoping for. And neither is REITs, although people believe that real estate never loses value. Of course, they forgot what happened during the financial crisis. Momentum remains positive and very much in overbought territory. You have the RSI at 71. MACD's got a positive cross. And look at this, 44 consecutive daily buy signals on this. Remember, we made a ton of money on home builders for our subscribers, but we think that trade is over. And look at this, again, momentum extended across every time period. Machine positioning long. This is a dangerous game here. shares. Let's take a look at VNQ, because again, we see the same setup here. Money flows into places that people perceive are safe, and then what happens when it's not, it tends to sell off. And there's only a couple cases, like right here, you go back to November of last year, where real estate actually did kind of buck the rising volatility trend. But in other cases, when we overlay the VIX again, what you find out is that real estate is not immune to rising volatility. As it goes up, you'll see each and every time there is indeed a sell-off in real estate, sometimes with a lag, suggesting that neither utilities or real estate is a safe haven that people are looking for. And as we talk about safe havens, well, emerging markets is definitely not one of those. Momentum still negative here. Relative strength index 39. That's breaking down. When you see relative strength under 40, you're seeing negative momentum. You have negative cross on the MACD. You've got sell signals building at 12 days in a row. And now the monthly momentum hitting negative. Machine positioning starting to move short. And this is a big indicator of liquidity for the market. When you start to see emerging markets drop, it is a huge red flag for the broad equity market. Now let's take a look here, and we see it's just holding some support just in the midst of this volume that's kind of built up here, but the major support isn't down here until 39.04. Now if you're wondering what this shaded area here, it's called Steve's zone of doom, because when you get down to this level, and I'll put it out on the weekly, what you see when you get to these zones, you're talking recessions, financial crises, major equity sell-offs. So what we're looking for here is a push of the VIX higher, the EEM to come down, and then if it holds there, that is your signal, of course, to get long the market. Maybe not for a long period, but maybe just get back long and take advantage of course, a reverse in positioning. But let's talk about bonds, because B of A says this is a place to be. Nomura now noting that their machines are now max long the U.S. Treasury market across the board. And what do we see? They're not sellers now unless 10-year Treasury notes come down to 111.72 at 114.14 right now. Let's take a look at TLT. Momentum's positive. RSI now in overbought territory. MACD's got a positive cross. And I'm just going to tell you, I don't think that this trade is going to last. I think it's going to rally a bit more and it's going to pull back. Because remember, the seasonality of August doesn't just affect stocks, it also affects bonds. For some reason, they tend to sell here. I'm going to expect that to happen again. But for the moment, I remember when people said this trade would never work out. Now remember, we put this on without stop losses. Well, look at this. I just told people dollar cost average in based on the reports. Look at that. Trade's up 4.55%. So if you find yourself trapped in a trade, just use our research reports to get out of it. And when you're ready, sell it. We're going to hold on to this position. We've got 6 consecutive daily buy signals. Momentum's positive across the board here. Machine positioning long as we predicted would get there. But I don't think TLT holds up. I'm going to show you where I think it's going and then where the likely pullback is, because this thing just broke through that 6-month volume profile and went straight vertical. The problem is it's got a major sell zone sitting right up here around 100. And if we zoom out further, what you see is this was a zone that people bought before. They got tapped out, sold down. It came back up. They said, no, we're not going to play that game again. And they aggressively sold a second time. Now we're getting up there. I imagine we're going to see bonds push a little bit further as volatility rises, and then sellers are going to come in, short the vol market, short the bond market, and look to buy the dip. Of course, we're going to wait for the machine positioning to get in position to do that. I think they're the big sellers. There will be opportunity here, but I don't think this is a cusp of the big bond market rally just yet. But let's talk about gold, because everybody believes that gold is going to be the safety trade, but maybe not, because the price action just doesn't look convincing. We have 4 consecutive daily buy signals on our reports. Machine positioning remains very long. Investors are really bullish on gold, and sometimes when everybody's all in and there's nowhere to go, it tends to go down. Let's take a look here, because you have again a double top. Now we saw a double top before, and you see a sell-off here. You have a double top, and what do you know? There is definitely selling there. Downside move here isn't fairly deep. It's around 215. You see the volume here. If it doesn't hold that, and you can see the buyer stepped in just at the tail end of this, but if there's a big enough sell down in gold, you're looking to see this drop all the way down here to 184. And of course, that's going to take the miners with it, because where the metals go, the miners follow. We know momentum here is negative. We stopped out of this trade as well. You know, we don't have a lot of trades on the books right now. We have one amazing trade that's sitting on the books that's coming on Monday that's going to show something at a 10-year low. We think it's got tremendous upside. You got 30-day free trial. Jump in, grab the trade. We give you all the details. Let's take a look at GDX here and see why that we're going to see a likely sell-off here in both of those. Because GDX has downside move here to 33.78. That's been a place of support. As you can see, buyers have stepped in here and the last two of times it got down there. But if it fails to hold that level, your next move right down here from a technical perspective is that 200-day moving average right around $31. You see where sellers are at. If it doesn't hold, you're looking at a move down to $29.71. Wouldn't surprise me if it overshoots that level, because remember, when the machines sell, they sell stocks, and guess what they hold? They hold gold miners for sure. Let's continue on here, because the dollar isn't as bullish as we thought here, with given the Fed's perspective of the market and holding rates up. We see momentum's negative. Relative strength index is 38. MACD's got a negative cross, and this is not a great sign here. Let's take a look at the dollar, because what we're looking for is strength based on what the Fed had to say, and we're not seeing that at all. As we zoom in, what you see is a left shoulder ahead, potential right shoulder, and from a technical perspective, you can see the line in the stand is right where this volume's at, sitting at 28.51. You see a breakdown of that. You're looking at 28. So the dollar here is looking to weaken, and this is not a sign of monetary policy, my friends. It's a sign of economic weakness, which is a very dangerous thing. So it's time to heed Bank of America's warning. Don't buy that first rate cut, look to sell. Of course, August is a terrible month for flow, so perhaps it's time to capture some of those gains and get some dry powder ready. There'll be an opportunity when the VIX gets higher to buy the dip, but don't make it something you own. Remember, it's a dip to rent, not to buy. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.